everyone. It's David Darst here to give you a recap of the month of July, filled with a lot of interesting news. July 4th, you had the passage of this big, beautiful bill, the tax and spending legislation in Congress. You have many tariff deals, the United Kingdom, Japan, South Korea, European Union, many Southeast Asian nations. You had the Fed deciding to stay on hold once again. This is 5 meetings in a row that the Fed has kept interest rates unchanged. Before the Fed meeting, there was a 65% chance of the interest rates being cut in September. Now it's down to 45% because Chair Powell in his news conference really did not give any encouragement to expect that. Earnings came out, Meta, Microsoft, Apple, Amazon. I would note that if the earnings were good, and they were good for Meta and Microsoft, the stock prices responded immediately and very positively, very positively. For Apple and Amazon, it was somewhat of a different story. Amazon, there was some disappointment in their Amazon Web Services. You have a lot of competition coming in now from Azure, which is Microsoft, and so a little bit more muted reaction for those two members of the Magnificent Seven. The IMF came out with its global update. They do it 4 times a year. The July update, they're looking for global growth to be 3% this year. Earlier in April, it was 2.8%, so a little bit higher. For next year, they're looking at 3.1% versus 3.0%. And you had a similar boost upward a little bit in the U.S. expectation. The first estimate of the second quarter, GDP, came in at 3% versus minus 0.5% for the first quarter. A lot of this was distorted by import and export activity in anticipation of the impending tariffs. So you have to strip this out. If you look at final sales to domestic purchasers for the second quarter, they were up 1.2%, which is the lowest since the fourth quarter of 2022, and that compares to 1.9% in the first quarter. So it's not as rosy as it appears on the surface. After rising, the S&P 500 6.2% in May, 5.0% in June. The S&P 500 for July was up 2.2%. NASDAQ up 3.7%. As you might imagine, some of this enthusiasm coming back to the artificial intelligence sector, up 9.4% for the year. Russell 2000 continues to lag, and you really would like to see the market broaden out more than it has been. The Russell 2000 is down just under 1% right now. It was up 1.7% for the month. Gold was basically unchanged for the month, and volatility was basically almost specifically unchanged, about 16.7 for the volatility index. Oil was up 6.4%. It's now down 3% for the year at $65.11 per barrel. Interest rates rose a little bit. They're still down for the year to date. They were up 22 basis points for the 2-year to 3.94%. Year to date, they're down 31 basis points, as you know. The 10-year was up 13 basis points to 4.37. You really don't want to see that thing rising too high because that'll put pressure on stock prices through compressing the multiples. NVIDIA, I would be remiss if I did not mention how NVIDIA did for the month. They were up 16% for the month. They're up 32.5% for the year, 177. It's just been an amazing rush of investors into NVIDIA stock. A lot of good news is already reflected in stock prices. Let me just emphasize that. And for stocks to meaningfully advance from here, you're going to have to see really, really good news. You need to see growth data continue to good and perhaps to be good and surprise to the upside. You need to going to see inflation remaining tame and continuing to slowly ease off to the downside. You need this tariff, the outcome of the tariffs on earnings and revenues to be stable and not contain a lot of significant surprises, and you need basically the market is expecting Fed cuts. Let me just remind everyone that August can be a very volatile month. People are on vacation, trading desks are lightly staffed, and you can get much more volatility. You remember August of 1998, the Russian debt default set off a lot of financial market volatility. August of 2007 began the subprime crisis, which then extended on in for another 12 months or so. August of 2011, you had the USA debt rating downgraded by S&P 500 the first time from AAA to AA plus. August 2015, the China devaluation of its currency, sudden devaluation, and August 2019, U.S.-China, again, trade conflict and trade uncertainty. Now, where we position ourselves right now is in this volatile time, and you want to reduce portfolio volatility. Private equity right now, historical outperformance. There's a lot of news flow about private equity. I think, look, the number of publicly traded companies has gone from about 7,000 in 2020 to 7,000 in 2000 to 4,000 now. In 2025. So you've had a reduction in the amount of public companies that you can even invest in, whereas the investable companies by private equity partnerships has gone from 2,000 to 11,000. So you get access to unique and emerging companies, which if you choose managers correctly, you can actually do this with reduced portfolio volatility. Same thing with private credit. You want to basically get attractive risk-adjusted yields out of that, portfolio diversification, some degree of portfolio stability, and some degree of downside protection. And finally, in private real estate, you get some degree of steady income generation, you get inflation hedge, and you get opportunity to invest in this huge build-out that's going on in the artificial intelligence sector. I'm talking data centers. I'm talking low correlation to public markets. With that, we thank you very much for being with us and look forward to catching up with you very shortly.